Your refinancing should support your immediate and your medium to future goals, right? So it's not just let's get it done now without thinking what is the plan, right? So if you're looking at investing in the future or innovating or reducing debt faster or improving your household cash flow, then it will make sense to refinance. But there's a few traps that you want to try and avoid if you're refinancing. Carlo, do you want to?
Yeah, I think one of the biggest ones, and there's not a lot of them out there at the moment, but chasing cashbacks from lenders, because a lot of people are driven by that. You know, they see a little carrot, big carrot that says we're going to give you a $4,000 cash back, you refinance your loan. If you're doing that solely because you get the cash back, potentially you're making the wrong move, and it's a big trap that people do fall into. But like I said,
welcome to another episode of the Brokers Lounge with Eddie and Carlo. And in today's episode, we'll be discussing the latest RBA rate rise and just see what that means for you as a mortgage holder, what that means in terms of extra cost, living pressures, and obviously just go through what to look out for and what to expect. But as always, before we start, Carlo, how you going, mate?
I'm good, mate.
You want to do it?
Well, thank you.
All right. And just a disclaimer, I won't be looking at Carlo as much because the wall makes me hypnotized somehow. So last week we were doing the episode.
Or hypnotize Eddie and make him dance like a chick.
I was falling asleep looking at him. So anyway, we'll get started. So basically, the RBA has increased the interest rate by another 0.25% this week, and that is the third rate rise this year, taking up the cash rate now to 4.35%, and that is the similar cash rate we had at the highest peak after COVID as well. So things are back to where they were a couple of years ago. And mortgage holders are obviously feeling the pressure, which obviously increasing interest rates, mortgage holders are the most affected people from that move usually. So that means higher repayments, and then that trickles through to cost of living, which is high already. So that's just another pressure on top of that. And then obviously the housing market becomes a bit tighter. Not many people are encouraged to, over leverage or push, or there's just a lot of speculation and a lot of uncertainty in the market at the moment. So in today's topic, we're going to go through, should you refinance? Should you look at what your options are if you want to restructure to ease the cash flow, to ease the pressure, to do something to get you over the next period of 1 or 2 years until things hopefully cool down a bit after. When does it make sense to look at these options? When you should just stay put, not do anything and just wait? And what are the common refinancing mistakes? So what does the latest rate rise actually mean, Carlo?
Yeah, like you said, it's, we're talking 0.25%. And I think if you look at it in isolation, it doesn't actually sound like a lot. But we've got to take into consideration what's been happening over the past 6 months as well. And, 0.25%, even on a $700,000 loan, you're looking at an extra $100, $120, possibly $150 a month, which even when you break that down, you go, well, you know what, $120 a month, that's $30 a week. Not a huge amount. Most people spend more than that on lunch and coffees.
Yep.
But the issue is that we've had cumulative increases. So we're now looking at, what have we had? 3 now. So that's 0.75%. So that's all of a sudden you go from $120 a month up to an extra $360 a month. And obviously the speculations around how many more we're going to be looking at as well. I think I read this morning that the big 4 banks are a little bit split in terms of how many they foresee, but it's probably not so much as how many more rate rises this year. It's the timing of them as well.
Yep.
But the speculation is probably another 1 to 2. which is massive. Like when, we were bleeding when it was, when we were at the peak. And then things obviously started to ease up a little bit, but now we're back to that peak again, like you mentioned earlier, and potentially surpassing that. So, this is really going to bite the household of a lot of mortgage holders out there. The extra issue that we've got now, which we probably didn't have back in COVID times, is the cost of living.
Fuel prices as well, right?
Groceries, like you said, the fuel prices.
Which is fueling everything else in terms of
Pardon the pun.
Yeah, exactly.
But yeah, it has a flow-on effect to everything. That's the biggest issue, increase in fuel means transport prices go up, which means it's got to be passed on to the end consumer at the end of the day, which means you go to the supermarket and all of a sudden your bananas, which used to be what, I don't know, should ask my wife, $2 a kilo, I don't know. They're probably like $6 a kilo now as well. So
$2, that was in the 80s, mate.
I am a little bit older, so just bear with me. But, it's just going to flow on through to everything that we do. And that's going to be the biggest issue. It's not a matter of can we cope with the extra mortgage repayments. I think a lot of people have hopefully built in enough buffer in their cash flow to be able to weather these increases. But it's everything else on top of that as well. And it's like, I think probably a lot of mortgage holders at the moment sitting there going, how much more can we possibly take? We've now got another thing to add into our cash flow. So, and at the end of the day, there's not any lender who's not passing on these increases. They're all going to pass it on. But people are paying significantly more than what they did 2 to 3 years ago. So it's going to be biting a lot of people. Gone are the days of where people may have been fixed as well with nice cheap rates. They don't exist anymore either. So it's just a matter of people are going to have to really revisit where they're at, have a deep, close look at their cash flow, and probably pose that one question is, should I look at refinancing now? So,
yeah,
you mate. So what do you reckon?
Refinance, look, we've been reaching out actively to all our clients just to book reviews to make sure we're on top of things, how they're looking, how the extra rate rises might affect them in the near future, and just being proactive, right, rather than being reactive, right? Because what I've seen in the past, some people, they just say somehow things will take care of themselves, right? Like rates are going up, their cash flow buffer is diminishing and it's almost non-existent. So another rate rise or two, and they're pretty much in the negative, right? It's like, okay, what do you do about it? It's not going to solve itself. So being proactive is really important. And that's why reviewing your loan, especially at such times, is really important to ensure you are on top of things. You understand what's going on. You understand what your options are. You understand what are your plan B and plan C in case things become worse. So reviewing the loan does not mean refinancing automatically. So my rule is to make sense of refinancing. You got to cover the refinance cost, which is usually around the $700 to move from one financial institution to the other. To be able to cover that and have a bit of buffer on top, then it makes sense. So if you're saving $1,000 plus from the refinance, then it makes sense to refinance. That's from like a direct cost slash, efficiency, if it makes sense to refinance. But sometimes we can negotiate your interest rate with your existing lender. So we don't need to move from one lender to another. Sometimes we might move to improve cash flow, where policy or valuation needs us to move from one bank to another, where we have to probably extend the term back to 30 years to ease the cash flow, where we have to probably go interest only sometimes, because in the short term, if you're going through issues meeting those commitments, I recommend like extending the term and doing interest only, because it's a long-term game. And if you manage to get over the next few years where it's hard, hopefully you can make up for it in the later years and make extra repayments to make up for the lost time. But the main issue here is not losing the property or going into default or having to sell to be able to, fix the problem. So what I've seen is a lot of clients, their current interest rates with their current bank, they don't get the better rate as a new customer. And that's something that's really annoying with banks, where they give new customer lower rates than existing clients, and then the retention rate for the existing clients is usually higher. So we have to either refinance internally to get them the lowest rate, or just refinance altogether to another bank. So yeah, usually existing customers often pay more. So that's why reviewing constantly, hassling the bank, pushing for a better rate, better fee structure is always encouraged. So reviewing is like we said, repricing the current loan, or restructuring, or checking the offset, how it's being utilized, how it's being used, improving your cash flow, whether it's through extending the term or going through interest only, or adjusting the loan strategy. So yeah, if you had your loan for over a couple of years, hasn't been reviewed, I highly encourage you to do that.
Yep.
Otherwise, you might be missing on something better, or better options. So there's a few things to look out for when you're overpaying. These things would be, Carlo?
Yeah, obviously, like you said, if you're on an older rate, that's going to be obviously number one, especially if you haven't reviewed it for a while. At the end of the day, lenders aren't going to proactively go out there and review your rates without you asking the question. Be nice if they did, but they don't. So, you need to be staying on top of this. Obviously, if you've come off a fixed rate recently, that's another warning sign to look out for, because your cash flow has been built around paying repayments on the lower fixed rate, and all of a sudden you potentially going, or not potentially, you probably are going to be going on to a much higher variable rate. So other debts, you may have other personal debts as well. So worthwhile having a look at that, because depending on the type of personal debt, interest rates are typically going to go up with that as well. Personal loans aren't too bad because they typically have a fixed rate built in it, but there's also personal loans that have variable rates. So every time the RBA increases rates, that's going to go up as well. And they're typically much higher rates. So all of a sudden that's impacting cash flow a lot. So another opportunity to potentially look at debt consolidation as well, so that you're not really chewing into your cash flow too much. I think it's one of the key things that we've seen a lot with people is, you ask people out there, do you know what your current interest rate is? And it's amazing how many people sit back and go, actually, I don't really know what my current rate is. And I've been guilty of this from time to time as well, because I haven't really needed to look at what the rate is. And if you've got multiple RBA rate increases happening from month to month, you can lose track very quickly as to how much you end up paying. Like, I've got a line of credit, and I looked at it the other day, I didn't realize how high my interest rate now. The higher interest rate on a line of credit is because it gives you the added flexibility, but you look at it now and it's like over 7%. It's like, okay, maybe I need to have a look at this structure going forward as well. But you really need to be staying on top of what your current interest rates are, and being in tune with what the market's actually paying is all asking for at the moment. So obviously another warning sign is if you start to feel the pinch in terms of your lifestyle, which is typically what has to change when rates start to go up. It's obviously, that's another sign to say, well, okay, maybe I need to have a review of my current interest rates, because I can no longer, discretionary spending probably a little bit different, because you can peel that back a little bit and go, I don't need to go out for dinner 3 nights a week or once a week or whatever it might be. But if it's starting to impact your lifestyle in terms of everyday groceries, to filling up the car, to paying the utilities, if you're constantly having to paying your utilities late, or getting extension plans, another warning sign to review your entire situation as well. So, because refinance is not always about getting the lowest rates. It can also be about getting the right flexibility, the right structure in place to suit your cash flow as well. So, probably a good segue in terms of when refinancing actually does make sense.
Yeah. Okay. So pretty much what we discussed before. I guess there's a few signs that it makes sense to refinance. So obviously, if you're getting a lower rate, and that lower rate will allow you to cover the cost of the refinance and have a bit of buffer on top. Reduced repayments. So if you're refinancing and you're reducing repayments by a decent amount, which will help with your cash flow, then it does make sense. Improving your cash flow, which is that's the reduced repayments there, or changing the structure or extending the term. Consolidating debts, as you mentioned before, if you've got personal loans or car loans or credit card debt, and that is usually on much higher rates, or the repayments are a lot higher, it makes sense to consolidate, improve your cash flow just to get over the tough stretch. And sometimes also to access equity, right? Like if you want to just take out 50, 100K, chuck it in your offset account, leave it there for a rainy day, or just to fall back on it until things improve, then that makes sense, absolutely. And also there's minor other features or reasons that we look at while we're doing the refinance. It's better loan features. So if you want to utilize a redraw or an offset or splits or whatever that is. So yeah, that obviously we'll look at those reasons when we're doing the refinance, and sometimes just policy makes better sense with other lenders. So your refinancing should support your immediate and your medium to future goals, right? So it's not just let's get it done now without thinking what is the plan, right? So if you're looking at investing in the future or innovating or reducing debt faster or improving your household cash flow, then it all makes sense to refinance. But there's a few traps that you want to try and avoid if you're refinancing. Carlo, do you want to?
Yeah, I think one of the biggest ones, and there's not a lot of them out there at the moment, but chasing cashbacks from lenders. Good old days is a big one, because a lot of people are driven by that. They see a little carrot, big carrot that says, we're going to give you a $4,000 cash back if you refinance your loan. If you're doing that solely because to get the cash back, potentially you're making the wrong move. And it's a big trap that people do fall into. But like I said, there's not a lot of lenders out there who are offering these cashbacks. Me personally, I'm not too sure about you, Eddie, but I'm probably glad to see the end of the cashbacks, because it did drive the wrong type of behaviours in the past. So the other thing would be focusing on low advertised interest rates. We hear this a lot where people are saying, you're recommending this particular lender at this particular rate, but I've seen this other lender and they're advertising at this rate here that's much lower. Why can't I get that rate there? There's more than just the advertised rate. There's typically something else that goes along with that. It could well be that it's just an online lender, or there's no branch, or there's no offset account. The features aren't there that goes with that particular loan. So you need to look at the bigger picture. Flexibility is a big part of that in terms of the product features. So making sure that you're looking at getting the loan that's going to suit you for the longer term as well. You can get that short-term fix, but you could sit back in 6 months time going, why'd I get that loan? It's just, I've got the nice cheaper rate, but it's just doesn't suit, our situation. So the other trap to fall into for a lot of people is extending the loan term back to 30 years. Now, for some people, it does make sense, but for others, if you're someone like myself, I've got 15 years to retirement.
I thought 15 properties, you know.
Oh, wish. I'd be retiring tomorrow if that was the case.
14, one short.
13 years to retirement, ease up. To extend if I had a loan and I was extending it and I had, say, 15 years left on my loan term and I'm extending back out for another 30 years, does that make sense to actually doing that? Yes, it will improve cash flow because the repayment's going to be a lot less. But it's just, you need to keep in mind that, extending your loan term back out to 30 years can be a trap. Not saying it's for everybody, but definitely worthwhile keeping on track with. Lower repayments typically mean higher long-term interest costs, because it's going to be going for much longer. So the interest costs a lot there. Other smaller traps to be mindful of is more around the cost side of things. So as you mentioned, to refinance your loan, typically comes with costs. You've got discharge fees. So you got to discharge the mortgage from your current lender. You got to then register the new mortgage with the new lender. The old lender will probably charge you an exit fee as well to discharge their loan. And then you got the new lender who's typically charging a new package fee, whatever it might be. So the savings you make from refinancing should actually make it worthwhile to actually cover those type of costs, but just be mindful of them as well. Refinancing may come with some valuation issues as well. You may have had a loan when you got their loan previously, different type of valuation. Market may turn, all of a sudden you go and get a new valuation done for a new loan, may come in lower, which could mean that you might not be able to borrow as much. It might mean you're on a higher interest rate because a lot of the loans are driven by what the loan to value ratio looks like as well. Tighter servicing rules, we're probably seeing that happen a little bit more now, where banks are becoming a little bit tighter in terms of when they're looking at from a credit point of view. So just be mindful of that as well. And assuming that approval is automatic. It's definitely not the case as well. So like I said, the lending environment is a little bit stricter than what it has been in previous years, but just need to keep it in mind and seek the right type of advice from yours truly.
Yeah, well, I guess
borrowers be doing at the moment, Eddie, then, if that's the case.
Yeah, I guess people need to be aware of what their, from a loan point of view, what their interest rate is, what their repayment amount is, what their loan balance is, and the balance and the limit can be different. So that's something also to be mindful about. So if you've got money in the redraw, your balance will be lower than your limit. Okay, so that's something that it's good to understand. Understand what your term is, remaining loan term is, and understand what your offset and redraw balance is, and understanding if your fixed various variable status. So I think being mindful of these things will allow you to be able to compare and see what your options are and understand if there's better solutions for you out there. Obviously, best thing to do is to speak with a mortgage broker. That would allow you to go through what your options are, what can be done, if anything can be done or not, because a lot of people that actually book a time with me, sometimes I say there's no point, right? It's not like we're just going to refinance for the sake of refinancing. So sometimes you're on a good structure, it's just rates are what they are. So there isn't anything better out there to do, then you just got to stay put and keep doing what you're doing. If you're having a chat with a broker, a few things to keep in mind. It's not just about the rate, right? Like the rate is an important part of the equation, but also try to think about your structure, about the future goals, about the flexibility. If something is going to change in your financial circumstances or personal circumstances, think about how long-term this aligns with what you want to do, right? So it's not just about the rate and the immediate repayment, which is very important, especially at this point in time. But since you're doing it, just go through the whole thing and ensure everything is linked and working together properly. So yeah, these are just a few points to think about. But as usual, we're always available to go through this with you if need be. So yeah, that would be all from my end, Carlo.
Cool. All right. Well, I think we'll wrap it up now. But I guess to quickly summarise, yes, there's been a few rate rises and there potentially be a few more. Doesn't mean everyone should go into panic mode. I think that's the first thing. Stay calm, get the right type of people around you to help navigate your way through this as well. But by all means, you need to be paying attention to your current loan, current structures, etc. Because sometimes it's just some of the small changes, and it could be small changes with your existing lender, can make a big difference over the long period of time as well. And if, like Eddie said earlier on, if you haven't reviewed your loan over the past, say, 2 years, now is definitely a good time to do that. So, and as always, speak with a broker before you go ahead and make any important decisions as well. So, the right strategy depends on your personal circumstances. So that's probably the key takeaways for today. But thanks again, everyone, for listening to our latest episode of the Brokers Lounge. Continue to subscribe to our podcast. Give us that lovely 5-star rating. That'd be greatly appreciated. And feel free to reach out to us with any particular topics that you want us to cover as well. We're always willing to listen and provide the right type of content for you as well. So, but until next time, I'll catch you later.
Thank you. Thank you, everyone. See ya. Bye.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Head to the show notes if you want to book a free call to discuss your personal situation.